Have you ever noticed that no matter what's going on in the economy or what's going on in the stock market, whether it's up or down or sideways, or if you're up to your eyeballs in debt, you're always being told you must put money in the stock market in order to have a secure retirement? Well, that's simply not true. Have you ever been told you're in it for the long haul, or don't take your money out, the market will come back? But has anyone actually shown you the impact losses have on your retirement? Now today, I'm going to do just that. Now, where on this graph are you going to retire? We have no idea. When someone tells you the market will come back, they're absolutely telling you the truth. But what they don't tell you is it could be 5 years, 15 years, 26 years, 29 years. We have no idea when the market will come back. Take a look at this. This is the S&P 500. The stock market crash of 29 dropped 89% and took almost 29 years to come back. The stock market of 69 dropped almost 69% and it took 23 years to come back. From December of 1996 to March of 2000, it went up almost 100% just to lose 50% between 2000 and 2002. Then in 2002, it shot up again for a 100% gain by 2007 and lost over 50% by 2009. Now it's skyrocketed from 2009 until 2022, and we're seeing massive losses in the market again. What was your money doing during this time period? Wall Street was getting paid. Your advisor is getting paid. Of course they want you to leave it in the market. But you're losing value from the time value of money, and you're losing opportunity costs from all this money you're losing. Now, how many times do you want to start your retirement plan over? The stock market has cycles. We know this. The market's going up, up, up during your working years. It's great until you get to retirement. Now, how are you going to preserve all those gains and create tax flow in retirement? We have a way to do this. So you've got this big bucket of money, you make all these plans, and then boom, the market crashes. What are you going to do for retirement? You're going to continue working? You're going to move in with your kids? Are you going to have enough to pay your bills? Now, they keep you in the market by advertising the average rate of return and convincing you that you're in it for the long haul, and somehow it's taboo if you capture market gains and preserve them. They never talk to you about the real rate of return on the investments you're getting. And they never want you to sell. They tell you you can't sell when it crashes because it's only a paper loss. And you've got to regain your losses. You've got to ride it out. But the other half of that truth is even when the market's up, your portfolio has no real value until you sell. And at some point, you have to sell. And those paper losses become real losses. Now, they also won't tell you how much the market has to gain back in order for you to recoup your losses. Now, I've got a chart on the screen showing you when you're losing 30%, the market's got to come back 43%. When you lose 50%, the market's got to come back 100%. But don't forget, you're also paying fees to your advisor and to the funds inside your retirement plan. So your portfolio has to gain more in order to recover because of these expenses. Now, we can't time the market, but there are plenty of indicators that indicate when the market is heading into trouble. Indicators like monetary policy, printing of money, changes in law, interest rate increases, inflation, job layoffs, company earning reports, housing market, wars, international financial problems. And even when the market is doing terrible, we don't notice our losses as much because we have been conditioned to continue putting money in the market and told that we will be financially better off losing money as the market continues to plummet than we would be if we quit putting money in the market and preserved our wealth. They came up with a creative term for this. It's called dollar cost averaging. They convince you that you're going to miss out on a gain, but you're losing so much more when you leave your money in your account as it declines. If you don't lose money and you wait for the market to come back, or wait for the market to bottom out, or close to bottoming out, you're not going to miss out on any gains. You're going to save yourself from losing money. And gains don't have as much impact on your portfolio as losses do. Why doesn't Wall Street ever want you to pull out some of your money, preserve it, and create some tax-free guaranteed cash flow in retirement? Why don't they want you to play it safe and let the market work itself out? Have you save some money and wait for the market to settle down and wait for some positive signs that may indicate the market may be on its way to recovering? Why do they want you to keep risking your retirement? Because they want all your money and they want it now. Now, is this good for you or is this good for them? The volatility provides no security in retirement. If the stock market provided security in retirement, then no one would ever worry about what the stock market does. Now, the stock market was never designed for retirement planning or cash flow in retirement. The stock market was designed so businesses could raise capital. The concept of retirement wasn't even a thought when the stock market was created. Now, I've provided some resources if you would like to do some more research. The overall market is highly volatile and affected by generally long cycles. 10, 20, or even 30 years is not long enough to ensure successful returns in the market. And that comes from Cressmont Research. New York Times, after 60 or 70 years, returns are relatively stable, but this time frame is longer than the relevant horizon for many retirement plans. In another article from New York Times, after accounting for dividends, inflation, taxes, and fees, $10,000 invested at the end of 1961 would have shrunk to $6,600 by 1981. From the end of 1979 to 1999, $10,000 would have grown to $84,000. Now, what is this telling you? Is the stock market about timing or long-term investing? I'll let you decide on that one. Now look at your graph. Is your retirement going to be on the downhill side of this graph or the uphill side? We have no idea. Now it's been pounded on our heads that we need to put money into a 401k or an IRA, or we will not have a secure retirement. But what security do these financial vehicles provide? They don't protect us from tax increases. They don't protect us from market losses. The volatility of the market gives zero security in retirement. If the market gave us security, no one would ever worry about what the market is doing. Now, why do you want this much uncertainty and unpredictability? Why do you want your retirement dictated by what the stock market and what taxes do? It doesn't have to be this way. The next time you hear an advisor or some TV personality talking about the average rate of return or telling you it's okay, you're in it for the long haul, that's an immediate red flag for you to know that what they are talking about is meaningless. We want to know the real rate of returns. We want to have some guarantees in retirement and some certainty in retirement. We want to preserve our wealth for retirement. Now, I invite you to reach out to me and learn more about other financial topics, but also learn how you can get some guarantees, tax-free use of money, and learn about the infinite banking strategy.